feel like I should feel like I should feel like I should feel like I should go. Go. Feel like I should go. Feel like I should feel like I should feel like I should feel like I should go. Feel like I should go. Feel like I should feel like should feel like should feel like I should.
GETCRACK. Wake up, motherfucker.
The jobs data in 2025 could be a wild card for the Federal Reserve due to several factors. Rapidly shifting immigration trends are making monthly job figures harder to interpret. Post-pandemic normalization and job growth concentration in a few industries like healthcare and government are also complicating the labor market picture. These factors may lead to unexpected fluctuations in employment data. Unemployment trends will significantly influence FOMC policy decisions. On January 10th, the unemployment rate moderately dropped to 4.1%. This decline suggests a strengthening labor market, which could lead to the Fed maintaining a more hawkish stance. The FOMC will likely view this as a sign of economic resilience, potentially reducing the urgency for rate cuts. However, the Fed will monitor other economic indicators, including wage growth and inflation data, to enhance their understanding of the economic landscape before announcing significant policy shifts.
Optimistic on stocks heading into this year?
So we are, Romaine, at least through the end of the year, we do see markets moving higher. However, we expect some volatility here, and we expect some choppiness throughout the year as markets really recalibrate not only to new policies, but also to really a new policy style. President-elect Trump has a more escalatory to de-escalate strategy, a more disruptive type style, and markets need to re-assimilate to that. So we think that does add to volatility here, and that's probably an opportunity for investors.
Well, where is that opportunity? Is that broad market opportunity, or are we talking sector opportunity, or even just single stock opportunity?
Yeah, so I say, in terms of broad market, it's U.S. over international, and then within U.S., we like large caps, and we especially like the more cyclical areas of the market. So industrials, financials, energy, communication services all look attractive here to us as we see the U.S. economy growing at about 2.5% this year.
But at the same time, there's a lot of catalysts that we should be aware of in coming days. CPI, for instance, in 5 days. Event risk, for instance, in 5 days. Event risk, really. So what's a good entry point for those who want to get invested in equities but are feeling a little bit shy given how volatile things are at the moment?
Sure.
What's up, guys? Hold up. I gotta reboot this thing. Hold on.
Sure. So, 2024 was a very unusual year in that we only had two downturns in excess of 5%, and we never hit a 10% correction. We typically see a 10% correction within a 12-month period. So if we were to see that 10% correction, we think that's a good opportunity for investors to start dollar cost averaging into equities at that point.
If the 10-year yield gets to 5%, can stocks still do well in that scenario?
So 5% probably so, but if we get much beyond 5%, then we think that's going to cause investors to reassess the valuations that we have on stocks right now. As you know, the PE multiples are very rich, and that is somewhat justified by the composition of the index and the growth rates that we've seen.
Yeah.
However, if we have to discount at more than 5%, then that starts to bring that valuation into question.
Just a real quick question. Only have about a minute left, Tracy, but I do have to ask you about the moves that we're seeing today in the commodities space on the back of concern about the incoming president in the U.S. and potential interplay of sanctions. Brent crude up at $80, WTI at 76, 77 bucks a barrel. Is that an investment opportunity as well?
So we think so. We see supply being constrained in the coming year, whether that's from OPEC Plus continuing to constrain supply on their side, or whether it's constrained supply on their side, or whether it's U.S. companies remaining disciplined. We do think that oil could reach $85 to $95 per barrel by the end of the year. And for some time, we have also favored precious metals. And we think that precious metals also are a good hedge to event risk and to inflation risk.
All right. Well, certainly those are the bright spots today in the broader market. Tracy, I have to leave it there. Tracy McMillian, head of global asset allocation strategy at the Wells Fargo Investment Institute.
Alrighty, so this is January, my bad, July. I wish it was July. Anyway, January 10th, 2025. Okay, so I didn't do nothing today. I did see the drop, though. So I warned, right? I warned you guys the past couple streams. I said, like, if that employment number was really good, we had a strong economy, stocks would drop, because Jerome Powell cares about inflation more than he does about anything else right now. So good news is bad news. You want to see bad news. So the last time we got a pump on the S&P 500 was when we had bad news on that manufacturing number, right? It juiced it up for a little bit. And then after that, you got a hot service number this week. And then you got Friday's report this morning. It was like, whoop, way too strong, way too good. So let's look at what we got here. And they were talking about valuations too in that video I showed you just now. And she was like, if interest rates get too high, above 5%, right, that means valuations come into question. That's where the problem lies. So when bonds start getting more attractive than stocks, people would rather buy that 30-year bond. I would bet rather, if like bonds right now are going cheap like crazy, they're going on sale, fire sale, and it goes to above 5%, they're even cheaper. So you can get a nice cheap bond right now for over 5% for 30 years. Why don't I just take that? That's the problem. That's really the problem instead of stocks. And also, it shows that for companies to get loans, they have to pay more, right? With more interest. So that's going to eat away at their potential growth and profits. There you go. So that's going to all come together right now. We have to see what's going to happen in the coming months. I think today's dip is maybe buyable, but you know, I didn't buy too much because I was like, dude, I'm just basically gambling at this point. All the easy moves at the beginning of the first 2 weeks of January were like, it's done, it's over. It was barely like 6 days of trading this year, right? And now it's just like looks crazy. It just looks crazy. because nobody knows what's going to happen in the coming next 3 weeks. And we got 3 weeks until we have big earnings coming through. All right. So let me show you this. So we'll continue on with the valuations here. Okay. Let me put on some music. All right. Let me see. Play my little violins. Maybe we're on the Titanic about to sink. Who knows? But here, Carl Swendlin. This is an old boomer. January 10th. This guy's always bearish. Okay, and here's why. Let me give you the link to the chart. I mean the article. How about that? S&P 500 earnings are for 2024 Q3, and here is our valuation analysis. So in stock charts, you got this nice thing where you can look at where the S&P should be when the PE ratio is like 20, 15, and 10. As you can see, we're way above it, right? We're just way above it. So the following chart shows the normal value range of the S&P 500 index, indicating where the S&P 500 would have to be in order to have an overvalued PE of 20. We're way over 20. A fairly valued PE of 15. So PE is price over earnings, all right? Blue line. Or an undervalued PE of 10, green line. Annotations on the right side of the chart shows where the range is projected to be based on earnings estimates through 2025 Q3. So approximately about almost the end of the year. So you see he drew these. So it should be at the end of the year, should be 4,750 if it was overvalued. If it was correctly valued, it should be at 3,500. And if it was undervalued, it would be at around 2,000, maybe 300, 400, somewhere around there. So this is kind of a like to that Brock value where they said like it should be at 3,600 something. I forgot yesterday, and the other stream before yesterday I was talking about. So this is where we should be, somewhere around here, but we're close to 6,000. All right. So if we were a fundamental analysis guy, we've just been rocketing way too far since a couple past 2 years. We just went way too high, too quickly. Now, historically, prices have usually remained below the top of the normal range, value line, red line. However, since about 1998, it has not been uncommon for price to exceed normal overvalue levels, sometimes by a lot. The market has been mostly overvalued since 1992, and it has not been undervalued since 1984. Christ, man. I might as well be a little baby, right? So if I believed all that, I shouldn't have been buying any kind of stock really since that year, because everybody would be like, it's overvalued, it's overvalued. We could say that this is the new normal, except that it isn't normal by GAAP, generally accepted accounting principles standards. So GAAP. I don't know if anybody knows accounting, but yeah, it's GAAP. All right. And most people don't care about GAAP anymore. They have something called non-GAAP. So if you look at those 10 Qs, they'll give you a GAAP number and then they'll give you non-GAAP. And software companies are notorious for just being like saying like, nah, you shouldn't look at the GAAP, look at non-GAAP. So then most people just inflate their numbers like even more gross proportions. Okay. And what can you do? You can't do anything about that. We use GAAP earnings as the basis for our analysis. The table below shows earnings projections through September 2025. Keep in mind that the PE estimates are calculated based upon the S&P 500 close as of December 31st, 2024. They will change daily depending on where the market goes from here. It is notable that the price over earning ratio remains outside the normal range. Okay, so you got your gaps here. There you go. The following table shows where the bands are projected to be based upon earning estimates through 2025 Q3. We covered that on the chart, so you can have that in a table version. So this decision point chart keeps track of S&P 500 for the fundamentals, PE, and yield, and is updated daily. Not that you need to watch it that closely, but is up to date when you need it. All right, that's not bad. Pretty good here. All right, that's very useful if you want to buy their service anyway. So you guys don't need to. As I said, I don't care about fundamentals. All right. The market is still very overvalued, and the PE is still well above its normal range. Yeah. Earnings have ticked up and are projected to trend higher for the next 4 quarters. Being overvalued doesn't require an immediate decline to bring valuation back to normal range, but high valuation applies negative pressure to the market environment. Okay, so that's your bear. That's your bear. Opinion, right? So there's something called this gap SPX thing that you can get from stock charts. Hey, what's up, Antoine? Yeah, what's up? What's up, Garion? What's up, 12 man? All right. So here you can get this chart here. Now I'm gonna pull it back to where the bull market started in the Great Financial Crisis, around here, 2013 or something like that. Now, you can see we had a huge boost up in earnings in 2021. So that corresponds with all the QE that the Fed was pumping and the zero interest rates that we were having for just a little while before they took away the candy. So they took away the candy in 2022, right? Took away the candy. So the stock market took a big dip, but earnings didn't drop that much, and then it recovered. Right? It started recovering because the Fed stopped increasing rates like crazy and slowed down increasing their rates. Right now they cut a little bit, and now we're paused. We are paused right now. Not paused as in the other meaning of paused, but you know what I mean. So you can look at the article there, and you can look at the chart here, but as you can see, we're pretty flat. Okay, we haven't been growing that much, according to GAAP anyway, GAAP. I'm sure if you use non-GAAP, those software companies are probably booming. They're showing huge growth, free cash flow, blah, blah, blah. This is the problem now we're facing. So today, this morning, we had these non-farm payrolls, all right? So they expected about 160K new jobs added. We actually have 256,000. Crap. Huge amount of jobs. And not only that, but the unemployment rate went down. So they expected it to go down a little bit, 4.2%, but 4.1%, that's 0.2% more. That's a big deal. That's a huge big deal. Okay, so this confirms that whole stuff with the service sector, that we have a tight job market in some areas of the economy, and participation rate is okay. But okay, so you have some reduced increase in hourly earnings, so the wages didn't grow that much. You see, manufacturing, you lost 13,000 jobs. See that? But where's all the other jobs being added? Well, we got some added from government. Okay, government. And then the rest went to private sector. So most of that is service, right? Okay, so interest rates, as I said in probably some October streams where I said, it's like the Fed has 2 sets of brakes, or let's say the brakes control the wheels in different rates. Okay, so if I put pressure on my brakes, right, let's say my left side brakes harder than my right side for some weird reason. That's what's happening right now. So it's really hard to slow down this car because one set of wheels on one side of the car is just slowing down at a different rate than the other. This creates big problems as we keep going. So if one side of the economy starts going down, but the other side is still going up, the Fed is really in a tough bind now. So they're not even slowing anymore. We're just seeing increased growth in one side of the economy. But they care about inflation. So what does that mean? Look at this. This is what's important. So at 30 minutes, or no, it wasn't 30 minutes after. So this was like 1 hour before market opened, right? And then 30 minutes after the market opened, this was the 1-2 punch right here. This one was a punch in the face. This one was a punch in the gut right here, because Michigan 5-year inflation expectations went up to 3.3. Damn, it should have been at 3.2. So if you look at this chart, people think inflation is still gonna stay sticky. That's not good. The Fed cares about people's psychology. If people believe that inflation is gonna stay high, then they'll expect higher prices anyway. So they'll accept the higher prices. They won't stop spending. They'll still spend. And they'll just expect prices to go up, so they'll compensate for it. So a lot of inflation is driven by the psychology as well as actual, price changes. This is a big deal. So the consumer won't stop spending. The only way this will stop is if interest rates go up to a point where, they'll be forced to not use their credit cards, but they'll probably get another credit card or something like that. And the other reason too, right, we got that buy now, pay later stuff we've been kind of talking about over these streams several times, the Affirm and all that with John and HB. This is going to add more things, so people can actually get lines of credit without actually having good credit scores, and they don't care about the interest rate, because as long as they pay on time, they don't have to pay interest. So that kind of shields people from the increase that the Fed is doing with interest rates. They'll only start paying interest if they miss payments. So this is adding some bizarre case where, okay, if I have my monthly payments when I do my buy now, pay later, I'll only have to see those interests when I miss my payment. This also shields the consumer from stopping spending habits. So if the Fed wants inflation to go down, it's not going to. Okay? This is a big problem. Now, let's go to the charts here. Let's go to the charts here, because there are a few things you got to know about. This is what I learned way back when. I forgot who taught it to me, but I remember I watched a presentation. Yields, dollar, oil, and earnings. So we covered earnings, right? We kind of covered yields. We had that video. Now I'm going to look at the dollar. The dollar today went up to 110. Man, so Europe is in a bad situation. The dollar is just getting way too strong right now. Way too strong. This is going to eat at the profits of companies that are multinational. Most of American companies are multinational companies. So whenever they have to repatriate their gains in Europe, so if they have money in Europe, they do business in Europe, and they have to pay taxes, or they want to spend more money in America, and they have to convert those euros into dollars first, this is going to hurt them. So when they go to earnings, so you'll see this in your earnings. So when you see the earnings, like conference calls and earnings results, those talk about something called FX cost. That's the currency exchange cost. So their profits will be eaten away by the currency exchange, because the dollar is just too strong. So this is what I'm saying. You don't want the dollar to be too weak. You don't want the dollar. So the DXY is the dollar index. You don't want this thing to drop below like 98 or something. And you definitely don't want this thing to be above 105. And it's been clearly like just hovering close to this 105 too many times. And the last time it was well above 105 was here, when the interest rates were going up really badly. And this was the actual bottom of the stock market right here, October 2022. So that was the bottom. That was the last bottom. And now we're just rocketing back up here. So far, the stock market has ignored it, because Powell said we're not going to raise interest rates. So even though interest rates, if I go look at this 30-year yields, it just touched 5% briefly today. The last time it was this high was October 2023. And then the last time it was high again was October 2022. So even though like here it got to a new high, that wasn't like a big deal to the stock market because this was the major point here. It was the rate of change. The change between November 2021 to 2022 was the biggest change. After that, we've pretty much gone sideways, right? So even though it it made a new high, but it didn't really panic the market too much. We had a little dip here in the S&P 500. Like here, I can show you. I'll put it in parallel here. So I got this red line. You see that? So you had a little dip, right? You got your biggest dip down here. You got another dip here. And then once it calmed down, we're up here. Now we're going back up. So that little lady you heard in that video said, she's not worried. If it gets to 5, maybe a little bit above 5, I'm not worried. But if it gets a lot above 5, okay, I'm worried. Now, all this put together, you got the dollar too high. You got the rates going up, probably going to be too high soon. What's the other one? Oil. Oil is the other part of the equation. So I told you, high yields, high dollar, high oil. If all of them together combined, they're going to make it real hard for the stocks to go up anymore. So let's look at the oil, right? So let's look at what crude oil is doing. Well, it's been trying to recover. It's still low, though. You know, it's not as high as back here, but it is climbing. And I don't think it's going back down again. China demand is probably going up. They're trying to stimulate their economy. We've been lucky so far. We've been really lucky that China's economy has been so crap because they locked down everybody for so long, and then when they stopped doing lockdowns, nobody wanted to spend because everybody didn't care about like the whole housing bubble thing. So a lot of people were broke. You know, all their investments are tied to oil. So we're in a different situation. Yeah, so I think oil will go up. We are going to go up here. And as she said, $90 is not unheard of, and I expect it to go up to a 90 at least this summer. So this is going to add more pressure to the Fed. So we got 3 things against us. 3 things against us right now. And I'm going to play a little video later towards the end of this stream where I show Samantha LeDuc's presentation. She'll say exactly the same thing I am. She'll say exactly the same thing I'm doing right now. And so when you add the valuations, right, earnings are not going that high. You have yield, dollar, and oil all climbing together. The yield are about to break 5%. Dollars is about to break 110. And then oil should go to 90. Once all those 3 things hit, yeah, that's a ceiling for the stocks. Okay. Anyhow, let's see what S&P is right here right now. It is at 580. This was not a good week. Now, next week, we'll have PPI on Tuesday, CPI on Wednesday. Those 2 pieces of data. Then we'll have our first big earnings with TSMC on Thursday morning. So we'll have 3 things to look at next week. You might say, okay, I'm willing to risk it, buy down here for recovery here. But if those 3 things don't go well together and we can't go back up to 600, what will happen is you'll have a half-hearted move up. Maybe you'll get lucky. Maybe we'll cover this whole candle here. But eventually, after next week, you'll have 2 more weeks after that where people are going to start worrying more about earnings and worry more about Powell when he talks on the 29th. And actually, I looked it up. The 29th also has earnings for Microsoft and Tesla. So those will be the next 2 big ones. I think we'll have Netflix on somewhere around the week of the 20th, somewhere there, like after Memorial Day or whatever, Memorial Day or something. I forgot. Oh, what holiday that was? President's Day? No, President's Day, the other day. Veterans Day. Veterans Day, I mean. My bad. Veterans Day. So there you go. You got that, right? So like I said, we got 1 pump Good. You got that trade. Got another pump. Got that trade, right? Short this one. You got that trade. Now is the fun part. Because now everybody's going to guess where the next shoe will drop. Okay? All right. That's the next play. But the first 2 weeks were easy. Very easy. Then the rest of the month, I told you guys, investors are going to hate January. Anybody that hailed through all your investments, you're going to have a bad time. Probably going to get worse by February, March if things don't work out for the earnings, right? If you don't get enough growth. So that's how it goes, man. That's how it goes. All right. So I think the best things to play right now is gold and silver because that's where I'm at. So this thing has been doing nicely. So I'm going to watch this level here. So it's been trying. So GDX is the ETF for gold miners. It touched this level. So I'm going to watch how it goes. I liked how it did today, though. Gold rarely goes up when yields are going up. So gold has been outperforming bonds. And this is like the old thesis that Russell Clark guy. I probably talked about one or two of his articles in the October stream. So Russell Clark, he's a big macro guy, and he kind of believed that we're entering a phase where we'll have permanent and high inflation. Bonds won't do that well compared to gold. Gold will start outperforming and continue to outperform. So we might be starting to see the signs of that. Okay? This is where it's going to be. Oh, White Dog Go, just say you're bullish. Oh, I'm a trader, man. I'm a trader. That's all I gotta do. Man, I just do shares. No, I don't do UVIX. Come on. Why I gotta do that? You can just do leverage ETF, man. Dude, today's is like, just use MSTZ if you want to short. Like, use that shit. There you go. Use your inverse MSTZ. I don't care about UVIX. There you go. You can just play this all day. Yeah, this is what you'll play all day. So yeah, so if you shorted here, right, 14 go up to 20, that's where I was. I don't know if I want to get back into this thing. I probably will go long because I kind of like how like Bitcoin did, actually. Kind of surprising in a way, but it had a good strength this morning, so it kind of recovered everything. Covered this candle over the loss during that whole initial jobs report thing. So I kind of like that. So I might go long next week. I don't know. Maybe not. That's all I gotta do. But yeah, but otherwise, no, I'm sitting pretty. Don't really care right now. I think the easy trades are done. Everything else is just like goofing around. It's just too much difficulty, I think. And I'll play the Samantha LeDuc stuff so you guys can see how she thinks of things. I think she's a lot more professional about how she goes about analyzing stuff, and she has that options guy, and he'll tell you about the gamma profile of the options that's being set up for the S&P. And I think her opinion is essentially it's going to keep going sideways. So she doesn't really believe in the down moves or the up moves. And I kind of agree that, like, yeah, this could be a fake out. It'll trap some bears that think like it's going to collapse right away to this level. It will eventually probably go here, but it'll just keep head faking people out back and forth. Like, the only way you get out of this is if you break 600 with force and conviction and get through these old highs here, and then you'll start to squeeze back up. Otherwise, like, you need to probably get through 575, that area. So I don't know where all the options would be, where it will just like create a huge squeeze down here and force everyone out. And it might be that we'll have to wait for the Bank of Japan to start a yen carry trade issue. And that was like the same thing that happened here, you see, this whole thing. So people are probably expecting something like this to happen, but what will trigger it? Like, it could just be earnings, right? It could just be Apple earnings or something. And once that happens, it's like, yeah, if Apple doesn't sell enough phones or have enough growth, then yeah, that's gonna be it. Like one other thing that was interesting was Tesla. Like Tesla's really fighting to stay near 403. Like if it can hold this through earnings and its earnings is all right, then yeah, it could just survive through the mess. But I don't know. Powell probably will just dictate everything we see here. Yeah. So let's just quickly go through some things. Let's look at the sectors. Okay, let me just look through the sectors for you guys. So I'm putting up a weekly chart here. So XLK still surviving. The two moving averages, 18 and 40, moving up. So we got this. The weakness that we see since July is because of semiconductors. That's pretty much what kept a cap on it. It hasn't really gone anywhere. XLC a lot better because it's mostly software. So as you can see, the only time it had this big red candle since August and like September, right? So all these three red candles, this red candle September, so the little one there, but most of it was green, green, green. And now we had Powell talk, and ever since then we never got back up here. So this is a big problem. We haven't even gotten back into this area since Powell talked, so that means we're going to have to rely on earnings and Powell altogether again. XLY, same thing, same deal. And I think XLY probably has a bigger expansion probably through Amazon and Tesla right now. XLF, this is a concern. So far, it's been trying to stay up, but interest rates have gotten too high. And usually you have high interest rates, banks do well. Because they can charge you higher interest rates while they get a lower interest rate from the Fed. But since the Fed is no longer cutting too much, probably only 1 to 2 cuts this year, interest rates being too high is not good anymore, since that means people are less likely to take out loans. So there's less customers to get loans. So now we're too high even for the banks to make money. Yeah, this is not a good look this week. I thought it could just go sideways here, but we got this after today's news. Not good look. Not a good look. Real estate. Oh, of course. High interest rates. Nobody wants to buy a house. Short this thing to hell. So if you believe interest rates are going to keep going up on the 30-year side, yes, keep shorting this. This is a good short. Short real estate. Terrible sector to be in. Energy. Thanks to oil, it's recovered since the end of last year, so looking good. Probably we're gonna wait and see if we can continue this, or maybe it'll take a break. Materials, same issue. This is mostly because of two things: China's weak economy and interest rates. So miners like lithium, uranium, all that not doing well. Industrials, so mostly interest rates causing this dip, but not too bad, I guess, compared to others. XLU, same thing, interest rates, so same issue with XLY. So utilities, utility sectors, they have dividends, and they compete with who? Bonds. So when bonds get a higher interest rates, I don't want my utility stocks. Staples, ooh man, even nobody wants to run away to Staples. That's a bad sign. Bad sign. So altogether, pretty bad. And then we have healthcare. Pretty bad since July. Hasn't been doing well. Pharmaceuticals, all that. So nothing really looks good except for sort of technology, communications, and discretionary spending. So those three are the top ones we have. Everything else sucks. And those three are the ones keeping everything up. And 7 to 10 of those stocks in the S&P 500 is keeping like everyone else up, because they're like 33 to 40% of the whole S&P 500, right? The Magnificent Seven. That's it. And that's what's keeping everything together right now. Because if you look at small caps, you look at mid caps, all bad since Thanksgiving, and has not improved since Powell talked, right? There you go. That's why everything he says is very important to how you plan yourself for this year. So like I said, not a good year for investors. It's not going to go up in a straight line like the past 2 years. That's why it's just going to be hell for most people who don't trade. That's about it. So far we're okay. So this is the Mag 7. I stripped out everything except the 7 top stocks. And if you look here, that's Amazon, Nvidia, Tesla, Meta, Google, Microsoft, Apple. All right. So far it's holding okay-ish. Not a good week this week, but not bad like compared to everybody else, because if I looked at IWM, look at that. See, this is what I was worried about. So we got that pump from Donald Trump, but then after Thanksgiving, it followed the rest of the interest rate crowd, where if you are sensitive to interest rates, down, down, down you go. So this is the broadening of the S&P 500 going up. No, you're not going to see that, because if the small caps are not going up, definitely the rest of the S&P 500 isn't having a good time outside of those 7 stocks, right, for the most part. And if we looked at the worst of the worst, biotech, which is heavily reliant on low interest rates, yeah, we are down 3% this week. No, this is what I was afraid of. So no go with anything right now. So I've been mostly in cash since Tuesday, and so little selective shorts here and there, but I'm not going to be convinced on doing anything major, shorting this market or doing anything of that until probably next week, and we see where we're positioned at. If we get a good position, then yeah, by all means you can go for it. You can short at whatever you want before earnings, when the big boys start reporting. But for now, no, I don't think it's just going to collapse right away unless the CPI or PPI next week turns out really bad, really bad. That's about it. Let's see what else we got. SMCI. Yeah, I don't know if I want to get back in long on this guy. I was like, so yeah, from New Year's to here was a good trade, but now it's just like, yeah, because early this morning it looked good, right? It did this pump while everything else was going down, but then we had this news about HP Enterprise. So Hewlett Packard won a contract for Twitter to build their data centers. So Dell lost and SMCI lost. So that took away the win in sales. So I don't know what this means. I'm like, oh, okay. So you erased everything you did this morning from no news, or was this just manipulation? I can't tell, right? I can't tell right now. But it was trying to do good. And then the other thing too is that if we look at semiconductors here, SOXX, we're going to really rely on TSMC to push this back up. So I did the trade here from 215 to 231. I just used SOXL. Yeah, so that was a quick trade too from the New Year's up there. So like I said, those was just an easy trade. Just go back up to resistance, and then it just dropped completely back to support. So what does that mean? Do I buy this back again? But then I'm just risking myself for earnings for TSMC on Thursday. So if I do another bet long here, I'm just betting on TSMC, I guess. Same thing with SMCI. It's just going to follow the semiconductors too. So if you know me, I don't like betting on event. I'd rather bet before the event happens, because this thing was just goofing around on the data that was being produced by the economic report, and it was just easy just to trade it up and down. But now it's like, okay, now it's go time. The next 3 weeks we actually have earnings, we actually have real data, right, from the actual inflation report, because so far we've been guessing what the inflation would be based on employment and all that. So that's what the market's going off on, and so it's just being schizophrenic, right? So that's it. That's all I gotta say. So the easy stuff is done. We got everything easy. So now I'm just waiting to see if I want to short again on Bitcoin or anything else, because I think that will be the easy one. MSTR will be easy to short this guy again. Like this was easy, like just shorting this one. But I was kind of pretty surprised that it just held this level, even though Bitcoin was going way worse. And now that MSTR is added to the NASDAQ 100, so it follows both Bitcoin and the NASDAQ pretty strongly. It held up pretty well today. Now I'm thinking like, I'll just go long and see if it gets back up to 380. At least like maybe 350, right? So that's why I'm trying to guess next week what I should do. But I think everyone else, stay away. Just stay away. Yeah, really, just stay away until like March, April. I think that will be the easiest play for most people. So most of you guys that are not trading, yeah, it will just be way better for you guys to prepare for April. And I think next week I'll just go over some scans and things. So we have to start thinking like we were in October, right? Start picking out stocks like Sound. What's the other one? Like, there was so many other ones I picked. I forgot what I did all October. But eventually what we have to do is we have to select a bunch of stocks for April that we all jump into. Okay, you all jump in there in April. So we're gonna have to behave like April is October again. That's like the low of the cycle for stocks. And then we start selecting out which ones we want to jump into and prepare to buy. And then when the whole market starts crashing, you get there and then you buy everything, and then it will just ride everything back up into the summer. And that summer will probably be the last one. Okay, so let me show you what I think will happen. And don't take this as real advice or anything. So I'm just gonna draw. All right, I'm gonna draw with my paintbrush here. So it's gonna be like this. Nyek, nyek. Right, nyek, nyek. And then it'll just drop here right into March. It'll fight a little bit here, and then in April it's just gonna go into May. It's just gonna drop, and then we get up. Something like that. Something like that's gonna happen. It's just gonna do this, this. The other alternative is it'll actually break out or something, and then like hover. It'll just do a hover right here, something like that. But I'm not really confident that's gonna happen. Yeah. Unless Powell changes tone. Unless he changes his tone, I don't think that's going to happen. All right, what else we got to look at? Chinese stocks. So China finally broke down. So now I'm going to wait and see how Trump's going to act. I think we can get really cheap Chinese stocks to trade in the coming months as well. Probably a lot cheaper than U.S. stocks. So they'll be juiced. They'll be really juiced for trading. Okay, and my favorite one was KC, right? But KC doesn't really follow China too well. So yeah, this week is down 10%, but it's still at the whole support level. The other thing to look at are utility stocks. So I mentioned CEG. CEG actually today was up 20% on news that it has a merger. So I'll play a video of that news, but very nice. So it bounced up, went back to this area here. This area on November 4th during elections, you see this drop here. It actually got dropped because of the news that the government won't allow CEG to provide all their nuclear power to Amazon or something like that. So a lot of nuclear stocks got hit. So CEG has a ton of nuclear holdings. So the merger actually will allow them to have nuclear holdings and natural gas holdings. So CEG will be a big powerhouse for natural gas and nuclear energy. So this utility stock is really going to boom, I think. And it's been doing very well. The only problem I have it doesn't have much history because it only started trading in January 2022. But I'm not sure if it was because it was IPO or what. Maybe it got merged by somebody else, and that's why I don't see how the price action was before it. But this has been doing very well, holding this line here since May. So it's been doing that, and then now it's been breaking out since New Year's, perfect. This is a perfect one. So I'm not sure if I'm going to add to this or not, but I think this is a very good long-term investment, and I will definitely probably recommend it again. If it pulls back and it can hold like 260, yeah, I'll definitely buy more. So this is one I'm thinking to do a bigger amount for a long-term portfolio. And then the other one is PCG, California Utilities. So interestingly, California has northern and southern California parts, and Northern California is mostly Pacific Gas and Energy, so PCG. So I have no idea why it's following like the whole fire story, but I guess people on the stock market are that dumb, or they just think like climate change will have like, that means this summer we'll have Northern California fires or something. But EIX is the utility for Southern California. This one is the one that should be getting beat up. And so PCG has just been following it. And I've been in PCG for a long time, and I sold a bunch up here. So I can buy back those shares that I sold down here. So I'm thinking of buying a lot more down in this area, because this box that I drew is really important, between 17 and 24. Once it gets above 24, it can fly back up to 60 eventually. So utility companies like this, they're a monopoly. All right. So I'm looking to buy PCG. So whatever I sold back up there, because I already saw utility stocks getting hit like after Thanksgiving. So I already started selling, right? So thank God I did, because I guess I got lucky or something. But I was like, oh, interest rates are going up. Well, utility stocks are going to get like slammed. So I'd rather just stay away and just sell some of this stuff that I have here. And now I'm thinking of buying it back. But then again, we have to worry about interest rates. If interest rates continue to go up, this thing isn't going to go recover anytime soon. So you have time to buy this. So you can be patient on this one. All right. They had a partnership with Microsoft. Yeah, that's correct. Microsoft. That's correct. CEG. The other one, HE. So HE is one of those ones. So I talked about this in the summer. So this was like a nice trade from 8 to 17. And I kind of joked the next day to John, like in one of those late night streams, like, yeah, you could short this now. So yeah, well, that would have been good to do, like short this whole thing. So now we're back at 8. So yeah, HB's been looking at this as well, because I told people like once it goes below 9, look to buy. Yes, we are well below 9 at 8, thanks to all the bad news with the interest rates and the fires, because Hawaii also had fires. So who knows? Maybe this move here is sympathetic to the fires in California, because people now are worried about climate change and whatever. So then they'll be like, oh man, just sell every utility company next to fire prone areas, and they probably just sold this in sympathy. So also look at this one. So this might be a gift buy as well, near 8. So if you can get it at $8 to $7, yes, I would probably be thinking about buying this one as well. So pretty convenient that I was talking about this recently. Okay, next one. Let me see. Oh yeah, Geo. So I mentioned last stream, Geo. It was up 8%. It's been doing nicely since New Year's. So yes, this is private prison. Very good since Trump got elected, up 75% on that move. Also, we have a Senate and House controlled by the GOP. So private prisons and detention centers for immigrants. Yes, this is probably the play to make for this year. I just mentioned it again for you guys. Another one is Mobileye. So I've been watching this week. Failure to break out, right? We have a down sloping weekly 40, and then now a turn on the 18. So we're going back to that 18 area. So yeah, I'm going to watch this, see if it's a good buy sometime later. But I think what happened here was not only because the stock market didn't do that well, for tech anyway this week, but because they probably said some things in the consumer electronics symposium or whatever the heck, the CES. in Vegas, they probably said something that wasn't up to what people expected. So that's probably why you got this nice red candle, almost 30%. Crazy. So yeah, things don't look like what they seem, right? So whatever looks like a breakout is now a breakdown. Not a good sign. Not a good sign. And like I said, just like IWM, something that looks like a breakout but then becomes a breakdown, no, you can't trust it. You can't trust it. So this thing, maybe some other time, might be good, but looks like not this time. So I'll keep watching it, but yeah, that's probably not going to happen then. So a lot of the stuff I mentioned, probably not going to happen. So the other thing I talked about last stream was Fannie Mae, Freddie Mac. Okay, so if you go back to the last stream, I'll show you why. Very nice. This has done quite well since Trump got elected. They're going to get this company out of conservatorship and go back into the private sector so we can have... So this thing's been dead since 2008, right? But as a penny stock, not Sam, I don't know, Sam Altman? Sam Altman is like the ChatGPT guy. I think Ackman. I forgot his first name. I don't know if it was Sam too. Some other Jew. Anyway, he tweeted something just before New Year's, and they just pumped that damn thing up. So I don't know if I want to trust that guy. I mean, that guy is not trustworthy. But yes, I have been looking at this stock, and I was looking how it would perform in New Year's, and Ackman had to pump this thing just before New Year's, didn't he? We had to pump this thing, his little baby. And if we look here, this area is just where it was back in March 2014. Yeah, it could break out, maybe. So FMCC, Freddie Mac, and then FMNA, Fannie Mae, I think. It's not FNMA, my bad. FNMA. Same looking chart, okay? Whichever. You can pick one or two or however you want. But yeah, you know, if you stuff it in your IRA, like this penny stock, eventually one day it'll go up. So that's something to consider if you got an IRA account, because you want something that'll balloon like crazy. Yeah, maybe this is a kind of a stock that you want to stuff in there. It's kind of penny stock. All right, done with that. And let's see what else. Okay, gold and silver. So EXK is the silver stock I picked. I had bad news this week, and so I started saying, oh, well, good chance to buy. I had a delay in some mine construction. So yeah, EXK is one. We played that one before. PLG, Platinum Group. This is a new one. So I said, okay, probably start adding here. We'll see how it goes at 130. So if you got it at 114, you could add here, and then maybe you can add more later, because precious metals are probably going up. And then KCG can go KGC, GC, right? KGC, Kinross Gold. Yeah, this is probably my favorite of the gold miners. Has a better chart than most. Like Newmont, yeah, this looks way worse, right? Yeah, so I rather play this one, AGC. Okay, he had a pretty good volume too this week, so that's saying something. Okay, so you got those three. All right, for your portfolio for mining precious metals. There you go. Very nice, very nice. All right, anything else? Nope. I'm done. Oh yeah, Lululemon, Ulta. Let me see how they're doing. Let's see what yoga pants are doing. See how that's doing. They're still doing good. Man, it's still holding up. So white women are really holding everything up together. All right, very good. Ulta makeup. Okay, that didn't do so well. All right, but it still held up kind of okay. So I don't know. I don't know what that says about the economy. But if I see those things collapse, I'm pretty bearish about the economy after. But so far, unemployment's doing good, so I can't say that's bad. But yes, we have good going on precious metals and utilities, right? I talked about that. All right, we're done. We're done with that. Let's go to the next video.
More on the markets and the economy. Let's bring in CNBC contributor Peter Bookvar. He's the Bleakley Financial Group Chief Investment Officer. Peter, always great to have you. You think 10-year yields are going to hit 5%? What happens to stocks in that scenario?
Well, just to add some what Tim was saying is it helps to self-actualize. Do you want to be paying 22 times forward earnings in that rising rate environment? When rates are low, investors can be very valuation agnostic. When investors believe that the Fed is going to cut short-term interest rates and save us, investors can be valuation agnostic. But when you hit the reality that interest rates have actually risen across the curve in the face of those rate cuts, and now the Fed may not even cut again, well, valuations may all of a sudden matter. And instead of 22 or 23 times, maybe 20 times is more appropriate, maybe 17 or 18. Well, if that's the case, then it's going to be tough for the market to drive much higher. Now, the market can say, okay, we're comfortable 22, and we can sort of not have much of a return this year if we've already priced in a lot of the gains. But this P multiple now all of a sudden becomes an attention focus if these rise in rates continues, which I think it will. And yes, 5% I do think will be touched again that we saw last summer.
So markets go down in your view, Peter. I mean, that's the bottom line. And is the bar for a Fed rate hike much lower in your view, or is that still off the table?
I don't think that's not where the Fed's head is. And I look at the payroll number today, and it just doesn't square with anything else I'm seeing. To me, job growth is probably more around the 150 level. Because while we celebrated the 256, which does include about 30,000 plus of government, ADP on Wednesday said private sector was just 122. I think the truth lies somewhere in the middle, and it's probably about 150. And that's a slowing rate of job growth relative to 2023. So I don't think the Fed's head is there. Now, of course, the inflation data next week is going to be big. If there's one thing that can sort of take the heat off interest rates, it could be a benign CPI number, which I think the services component can deliver that. But there's also more that's going on here. It's the global rise in interest rates. I mean, you essentially have the global bond police that's driving through all the different neighborhoods around the world and calling out governments that have excessive debts and deficits and wondering whether they're going to be able to sell that at the price these borrowers want to sell at, whether it's Japan, whether it's the UK, France. And it's now becoming wider spread. It's falling into Germany, which is economies in a recession, to Germany, which is economies in a recession and with higher interest rates, and Australia and Canada. And also one last thing with rates that's not really being discussed around markets is the Bank of Japan is probably going to raise rates this month, and they continue to reduce the pace of their QE.
Bank of Japan. Yeah, man, that yen. If that yen goes crazy, we're gonna drop.
First quarter of 2026, they will have cut QE in half. That is a major liquidity spigot that's being turned off that I think is behind the scenes impacting global interest rates, just as it did last summer when they eliminated yield curve control and the U.S. 10-year yield within days started its ascent to 5%.
Peter, when you look at the revisions that we've seen last year in the jobs numbers, we saw the biggest revision since 2009. Do you think that could be a little wonky in the differential that you talked about? And secondly, when you take out Mag 7, you're concerned with valuation. When you take out Mag 7 and you look at forward versus forward without Mag 7, it's a couple of percentage points different. When you look at current, it's about 10 handles different.
Agreed. You can drive a truck between the P multiples of the growth stocks and the multiples of the value stocks. I think this is the ideal situation where value finally catches up to the growth trade, and that the stocks most vulnerable are those growthy high PE multiples. Those that are less vulnerable are the cheap value stuff. Now, with respect to the revisions,
Okay, do you hear that? You hear what they said? Drive a truck through the multiples of value versus growth stocks. So a lot of the stuff I said at the beginning with that article, talking about those PE ratios, it's very high due to the growth stocks. But if you look at the value stocks like oil, natural gas, those type of boring stocks, mining stocks, precious metals. So, hey, maybe those stocks are the winners this year, right? That's what I'm saying. That's what I've been saying.
Are just a week after December ended, and the government is supposed to come up with an accurate jobs number. It's just physically impossible, and that's why we get a revision next month, a revision the following month, a revision a year from now, and that final number is going to be very different than what we heard today. And it's also just because of there are less businesses that are responding to these surveys, and so on and so on. So that's why I think when you analyze the jobs data, you got to look at it all together with a lot of different data points.
Okay, tough, not clear, right? Nothing's clear. Oh, okay, well, now let's look at oil. Let's look at the oil. All right, let's see what oil says. What does oil says?
Stocks closing sharply lower after a hotter than expected December jobs report and a jump in inflation expectations. 10-year yield surging to its highest level since late 2023. Let's bring in Allianz Chief Economic Advisor Mohamed El-Erian. Mohamed, good to see you. So you combine those inflation expectations with the hot jobs report. What has to happen for this to be good, say, for an S&P that's already trading at a historically high multiple?
So first, it is good that the economy is doing well, John. We must not lose sight of the fact that U.S. economic exceptionalism provides the only locomotive of growth for the global economy. So as disrupted as markets may be, because this was a hot employment report, the alternative of a weak one would be much worse news for not just the U.S., but around the world. In terms of what it means for investors, investors are going to be increasingly pushed into a barbell, looking for high quality yield over here and being more opportunistic over here and more agile, including going to private markets. I think that what you're seeing is this transition from market-based investing to theme-based investing, and now it's going to be much more individual names.
Okay. Well, now also that we have this jobs report behind us, attention's going to turn to earnings, but we've got the strong dollar. So for multinationals in particular, how's that going to affect guidance?
Yeah, and we also have an inflation report coming up next week, as you discussed earlier. Look, analysts right now have to take seriously that the dollar index is almost at 110, the euro is almost at parity, and that is going to impact multinationals. And they should take that into account. And it's going to be a headwind to U.S. denominated earnings from abroad. And just the reality of U.S.
Yeah, that's what I said, right? When you repatriate those dollars from overseas in these multinational companies, it's going to hurt their earnings.
For the world.
Mohamed, I'm going to ask you a question I asked Bob Elliott earlier, and that is, are the bond vigilantes back in this market? And by the way, not just here in the U.S., but globally, especially when we look at what's been happening in the U.K., for example.
They're definitely back globally. And what you see in the U.K. is that very strange combination of them having had higher increases in yields than us, and yet that currency has weakened significantly. That combination of high yields and weak currency, you typically see more in an emerging economy where bond vigilantes are much more active. So yes, they are back. I think what we are having here, Morgan, is not as much the bond vigilante, as much the reality of three things. One is growth is stronger than anticipated. Two is inflation is stickier than anticipated. And three, we have the reality of high deficit and high debt.
I want to get your thoughts on this quiet climb we've seen in crude oil in recent weeks. Energy stocks are actually the best performing sector to start this year after being the worst performing in the S&P last year. But oil in general has been moving higher, maybe part of it's sanctions, but is it sustainable?
Yeah, I mean, you got a 3% move today. You've had a 10% move over the last few weeks. This is significant, and it adds to the inflationary pressures. The one today is purely in terms of sanctions on Russia that the market believes will be much firmer this time around than they've been in the past. So you're looking at a supply side issue. And the big question for is whether OPEC Plus will, OPEC in particular, because the plus side is Russia, but OPEC and Saudi Arabia in particular will want to increase production. But this is all supply side. It is not a demand issue, it's a supply issue.
And the demand side will rely on China because Europe is going to crap. So don't rely on Europe to burn more oil. Anyhow, let's talk about the winner of today, Constellation Energy, my best utility so far.
Energy is acquiring Calpine, the largest U.S. producer of energy from natural gas. It's a cash and stock deal. It's now valued, given that move up in Constellation Energy stock price, at roughly $19 billion, perhaps even a bit more. Joining us now for more on the deal is Constellation Energy's CEO, Joe Dominguez. Joe, good to have you this morning. In the title of your deck to sort of explain what's going on here, you call it Creating the Right Company at the Right Time. So why is this the right company, and why is this the right time?
Well, let me start by saying Happy New Year to you. I almost fell off my chair a moment ago when I heard Jim Cramer on your show here talk about me as some sort of expert. But look, here's what we were thinking. We wanted to create the kinds of capabilities and put them together that will power the U.S. economy at a very special time where we're seeing significant growth, not only in the data economy, but really across the board in a lot of different regions. So we like to follow where our customers need us, and that's what we think we've done here.
Yeah, I mean, you're talking about unprecedented demand growth projected for the U.S. It's not just your expectations. They're broadly shared. What gives you the confidence that's going to be correct?
Well, look, I think what gives me the confidence is that we're seeing the activity on the ground. You know, Microsoft the other day announcing $80 billion of data center spend. That's one data point, but it's a significant one. The number of interconnection requests we're seeing for new customers and load of a size and scale we haven't seen for many of us in our lifetime. So all of the data points are going in the same direction as you know, and as you pointed out, it's not just us saying it. We're seeing a lot of activity on the ground, and the grid operators are predicting it in their forecasts.
Yeah, well, and that's resulting obviously in what you're continuing to see is 13% EPS growth for a long period of time, and now you're talking about a 20 to 25% addition as well to that base case as a result of this deal. Joe, what gives you the confidence that you can meet those kinds of growth targets?
We've got a great team, and Calpine.
Okay. Eric, no, I don't clip this stuff. It's like I get them from the CNBC website. They have the clips already, or the Bloomberg. They'll try to clip out whatever, so I just take it from there. I used to watch a lot of the Bloomberg anyway before they got so political. Bloomberg got really political lately. Before they got political, like Bloomberg was really meat and potatoes financial analysis. CNBC is way too sensationalized. It's like the CEOs, like you see here, they come on there to pump their stock. Kramer does all these crappy calls. But Bloomberg was always pretty straight and pretty balanced, and they were all just like trying not to like pump things too much. But nowadays it's like really political, so I don't watch too much Bloomberg. Otherwise I would just clip more Bloomberg stuff. But if I started this show way back when, I would have did more Bloomberg clips instead of CNBC clips. But CNBC is really convenient, so you can see like when you play these clips from CNBC or you watch CNBC, you kind of like have to take it with a grain of salt. They're on there to pump something, right? And I usually try to say like, okay, all right, you're here to pump your stock. It's never good. Like a lot of times you see Palantir getting pumped too. And actually I have a screenshot. Here, let me get the screenshot for you. I got the screenshot today. Like, this is pretty funny to me. So like you go on these like CNBC, like look at the comments on them too. They're pretty funny. And you could go to any financial streamer. Like there's a lot of like popular financial streamers, right, that try to grift and try to pump their picks. And then you see this stuff. Let me see. Let me get this screenshot. Like here, right? Nvidia and Palantir losing my 2024 profits. What is the fire sale all about? Bonds aren't at all-time highs. inflation for longer, so data centers and data aren't going to be in demand as much. This is crazy. Now, I'm just like wondering, how did you lose like all your profits from last year already? And we're just like 6 trading days into 2025. Like, what the heck did you bet? Did this guy just buy a bunch of calls on Nvidia and Palantir at the top or something? Like, the only way you did that is like you did options. Like, you just were retarded. Like, I don't have no clue what's going on. Like, how could you lose all your money already? We only have 6 trading days, man. So so this just blows my mind. You know, a lot of people, like, you go on CNBC, that's probably like they'll tell you, buy Palantir. Hey, where were you guys when Palantir was like $7 and $8? Where were you guys at? Now you talk about Palantir like almost every second now on CNBC, right? So that's why I always like, oh shoot, it's time to get out of here. So it had a bad week, like down 15.8%. That's why it's like, dude. New Year's, when you look at the New Year's between December and the New Year's, you got to see where people are selling. So probably people kept as much as they could into the New Year's and then sold once they got back from vacation, because it's like, oh man, the market isn't doing that well, so I better just sell. And so they'll take their tax hit for the next year. So the 2025 tax year, they'll pay their taxes in 2026. So a lot of individual investors will just be like, yeah, I'm out. So right, this makes sense. And then you look at Nvidia, it made a minor new high this week on like the hype before the keynote address by Jensen Huang on the CES in Vegas, right? The Consumer Electronics, whatever, symposium. And once that was done, they just sold with the rest of the market. So now it's down 6% for the week, right? So it's like, come on. This is not the time to be buying. So I have no clue what that dude is doing. No clue. But if that dude was buying at the high this week and just burnt everything he did, so that's why I said CNBC, you watch those things, take it with a grain of salt. Always in the back of your mind, you're like, this guy's trying to pump his stock, trying to do this. So we have this Constellation Group, Energy Group, or Energy whatever CEO on here, like saying, oh yeah, this merger's great, whatever. Yeah, I like the stock. Yeah, I'm in it, but you know, it's kind of like, well, let's see where it goes from here, right? I wouldn't be be a new buyer. I was like being a new buyer down here during the whole November to December like sideways motion at this resistance support level. And now we broke out on the New Year's. Very nice, but let's wait and see. You know, let's not get ahead of ourselves and try to pump this stock, all right?
And Calpine, has a wonderful team. We've been delivering on that for 3 years in a row now. And so when you have the best team and the best collection of assets, you have a lot of confidence. That's where I sit.
Natural gas is going to be around for a long time, or so you say. Why is that?
Because we can't grow zero emission megawatts that fast to meet this growing demand. We knew that before this load growth. I think it's powerful that even in California, which has been leading the energy transition, the grid operators are saying that they're going to need natural gas at these volumes for decades to come. That was before, frankly, we've seen some of these revisions in load forecasts. And the story is true across America. The load that we're seeing coming on, the demand that we're seeing coming on, particularly from the data economy, is 24/7 energy demand.
Ooh, boy. AI needs that energy.
It's going to be able to meet that with intermittent resources. Renewables are incredibly important to the future of the country. They'll continue to be very important. But the reality is they don't run all the time. They're unpredictable. We need resources that could step in and meet the consistent demand that we're getting from our customers. So we need a collection of different resources to work together. That's what we're building here at Constellation.
Okay, so Constellation got the nukes, They got the natural gas now with that merger. Perfect. And we're going to talk about natural gas prices right here. So I said on the past few streams, I said like, oh, well, if we get through this red rectangle here, I might short it. So now we're up here. So, okay, I think this is it for this month. I think from here on out, it's going to have a hard time going back up. So I did the short with cold on here last Monday, because that was kind of an easy spike trade where you're just like this going up here. So that was like a 20% or something like that. And if you did pre-market, you probably got 30%. Now we're back up here, and cold, the inverse ETF of natural gas, is back down at 35. So I said like, why not give it a shot? I don't know. I don't like doing these trades before a weekend, because then you have all the weather reports that come out that might boost this thing. So this thing might actually keep going up. I don't know, clue, but let's give it a shot. Let's say it fails here. It goes back through here next week. Okay, from this point. And then once it breaks down, then we're going sideways. Then once this is done, I'm not saying it's going to go all the way back down here, 3.5, 3.4 dollars a million barrels of million British thermal units, or even going down here, but at least like we're going to go sideways between this range. So I drew these dotted lines. This is the spot natural gas index. So I drew these lines from here, 2021. It's like these two areas here. This was like the prelude to the Russia-Ukraine thing, which shot this thing back up. So this was kind of like a blow off top, goes down, crashes. And this was due to the fact that China was going into a spiral down, and their coal prices were going down. And incidentally, European weather was very mild for the winter. So European weather was mild for the winter, mild for the summer. So you had three effects. And that's probably what kept like Europe from crashing earlier. Europe probably should have had worse times during these years once they got their natural gas energy cut from Russia. And now that Ukraine is cutting more of their supply, so they're getting even less natural gas now. They're going to rely on Trump to try to give more natural gas to them over the summer. Our natural gas is now rising again, and we will see. We will see. I think here is a good place to stop, because in general, during the winter, it should start dropping down into the spring before going up. I'm not saying it's going to go all the way down here, but it's probably going to go at least sideways, because like the cycle stuff, I did the cycle analysis for you guys. It shows that this thing is going down in February. So late January into February, this is just going to go sideways probably. If we're bullish, it's just going to be like boom, 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 boom. And it's kind of like if we look at Bitcoin, it's the same thing. We have a bad cycle coming up. So Bitcoin will probably, if you're a bull on crypto, you want this to go sideways from here. But that's not a guarantee. If the NASDAQ is going to go down sometime in late February or early February, then yeah, this will just follow it. So it'll break through 90. Once it breaks through 90 on Bitcoin, yeah, you're going down to 70, 60, right? So that's what you're going to have to watch out for. That's potential. Natural gas, though, is a lot more bullish. I think it can go sideways into the spring. It doesn't have to necessarily go back down here, but it's still a possibility. So everything is still a possibility that would happen, even though we're very bullish right now. So for this, what we want to do is wait for that, and then I'll start talking more about like natural gas stocks in the spring, and then we'll see how that's going to go, right? And then from there, we'll be good. That's what I'm watching for. So natural gas is my bullish play for the year. I want to get the right entries for you guys at the right time. This ain't it. This ain't it. So I would rather be shorting the commodity, because I'm thinking it's going to go down again, and it'll just continue on here sideways. That's what I'm thinking. For crypto, that's a different story. I'll probably be more bearish on this one. So the next time it goes to 98 next week, if we're very lucky and we get good inflation data that'll juice up the NASDAQ and it'll juice up that, then that'll be the next time to short again. So this was the first shot of shorting. Now you're waiting for the next shot to short. But for now, if you want, you can try to go long and see if it can get it back up to 98. Or if you're lucky, maybe even 103 next week and then go back down. Okay, so I don't think this is a straight line down. I don't think this is a straight line down in either case. It's just going to be zigzag, 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 zigzag. So it's not going to be a clean shot like we did from November up here. This is not going to go straight back down. Nope. So, but crypto, yeah, it probably after we go one more leg up, then we'll go down really badly. That's probably more likely what's going to happen. But again, you got to rely on Powell. Everything depends on one man. It's just Jerome Powell. It has nothing to do with what I say. What I say means nothing compared to what he says, right? Okay. So we're done with that. So I'm going to play Samantha LeDuc's thing, and you'll see more, like, you know, she has more expertise than me. So I think it's better you listen to someone with more expertise.
Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings and happy new year. Thank you very much for joining us. It's Macro to Micro Options Power Hour. I'm Samantha LeDuc, founder of LeDucTrading.com, and joined by our mentor options mentor and educator extraordinaire in our LeDuc Trading service. And we want to welcome Hans Albrecht into this new year since we haven't talked for a whole month.
That's right. Happy New Year.
A month ago, we were actually slated to do a Wednesday. I was sick as a dog with no voice. The next Wednesday was Christmas. Right after that, it was New Year's Day. So here we are. And we really haven't gone anywhere very fast. I mean, the market has really been a sloppy mess since the Trump bump back on November 5th. We really have been going sideways, kind of like a crazy Ivan move under the surface with the main index, while the breadth underneath has been deplorable. So something that I follow very closely from an intermarket standpoint. And today, so December 2nd is when it actually started. Today's actually finally where it reached a level where it could get supported. But there's also this saying, as you know, that markets don't crash from overbought, they crash from oversold. And this breadth destruction has been really intense as yields and dollar have moved higher. So I think we should get some stabilization, but it would not surprise me if we do a quick little, volley into the pre-Trump bump. Obviously, everyone's got eyes on that prize of the gap fill. So let me get your thoughts on market help and direction. And then, of course, we can get into sector rotation and particular trades. And, of course, VIX. So what's your thoughts on this sloppy market?
Yeah, so you're right. People are hoping for the post-Trump election bump to repeat itself as a pre-inauguration bump. And in between, it's been a little bit of, like you said, just kind of, I'm looking at this chart right here, S&P return contribution over the past month. It's basically been the MAG. I mean, I don't know if you could call it MAG 8, but if you throw in Boeing on top of the MAG 7, you pretty much have a big chunk of the performance, whereas the rest of the S&P is down about 3.39%. So it's kind of back to the future again, isn't it? To where we were maybe 5-6 months ago, where it was kind of all about MAG. And we kind of talked about how this was a bit possible at some point if we did get that kind of higher for longer rates possibility, which I've been kind of thinking about since August, that might happen. I mean, I'm not sure they're going to raise rates at any point, but if we do get some data, some stronger data, what do you think of the data today, Samantha? I mean, we got kind of hot and cold on the job front, right? We sort of got a little bit of not as bad on the jobless claims, and then a little bit conflicting data there. So the market maybe took it as a little bit negative, but I think more of that is probably we're kind of sitting in this pocket of negative gamma. So, you know, this is kind of one of our terms that we brought to the forefront last year when we talk about gamma. And as you and I always talk about, we have to pay, you know, even if we're not option traders, we do have to pay attention to some of these volatility concepts, because and gamma is part of that.
I should pay attention to the gamma stuff. Pay attention to the gamma stuff. I never talked about gamma. You know, I'm not an options trader. But yes, like he said, even if you're not trading options, you got no options because this gamma concept comes into play as to how we're gonna do in a trading range.
As it's the dog and the tail reversing roles here. The derivatives markets are very, very influential now on equity markets. So even if you don't trade a single option in your life, you kind of want to pay a little bit more attention to what's going on. So we'll talk a little bit about gamma as well. And I think that's basically to your question. I think we're just kind of sitting. I've been telling members, listen, anywhere below 59.75, and we're kind of sitting in that pocket of either sort of neutral or slightly negative gamma. It's nothing to be super, super concerned about, but it isn't that nice cradling, supportive, positive gamma that we had above 6,000, between 6,000 and 6,100 before that massive expiry in December. We just had this incredible, even after expiry, even sort of towards the end of December, we had this big, massive gamma sort of support there. And then as soon as we lost that after December 30th, after the near term collar, of course, they rolled the JPM collar, but the near term effect of that gamma was lost to us. Now it's kind of distant. It's kind of like we were near the planet. Now the planet is far away. So the collar doesn't have as much influence anymore, but we're kind of floating about, as I like to say, we're sort of free to roam about the cabin. And that's exactly what the market's been doing lately. I think partially because of that, and partially, I'm sure you would agree, is the rate environment is just kind of starting to spook people a little bit.
Finally. So this was the post that I sent out even Monday morning, right? So we're Wednesday, tomorrow the market's closed, Friday's non-farm payrolls. I'm not trusting very much the jobless claims. I'm waiting for a much higher trigger to get really worried, 267,000. So until then, it's really just noise. I'm waiting for the signal. Continuous claims do continue higher. And then we did have headline jolts, which was looking good, but underneath the surface, it was not. So data day to day is not what grips me. What grips me is how the breadth underneath the surface of the market is still broken. So I wrote this Monday morning pre-market, markets in repair. I should say disrepair, but in other words,
Canada. You got the Canada on the screen
and
there.
Trudeau, of course, was the reason why the dollar literally on Monday had a big little snapback exactly at my 109.30, which is ironic, but 108 is surprise. So we're talking Dixie. This is the weekly. I know it looks messy, but the point is it's still very, very strong. And the market itself is not. So Mag 7 is still compensating with its strength for the headwinds that are growing. And that also includes yields. Now, I know I'm showing everyone right now the yield curve, the 10 and 2-year yield curve, but this was something that I obviously have very focused on. When I said September 18th, it's time for a yield spike, and then December 12th, ready for a yield spike. So this means that the 10-year yield is rising faster than the 2, and that's actually picking up speed. So now the market has gone into this chop zone because it is aware that the dollar is very bid. It's aware that the yield curve is steepening, which is putting literally term premia is positive, move volatility is picking up. And then you add to that, and you actually have oil that has come up off the ground. So when you kind of literally, it's trying anyway. This is crude oil chart. So when you start looking at Q1 2025, it's not really a great tarmac for a soft landing.
So there you go. So she repeated everything I said on this presentation. Dollar, yield, oil. Okay, so what's the fourth guy? Earnings. That's the only one you don't know yet, right? We got earnings season coming around. Earnings has to overcome all those headwinds. High yields, high dollar, high oil.
When we talk about higher energy prices, higher financing costs, and then of course, higher dollar is very expensive when it comes to currency conversion. So overall, I'm still focused on those three. At the same time, I can see that Mag 7, this is a ratio of Mag 7, right? So this is kind of imagine this is the Qs that have literally, since the January low, they've doubled. So Mag 7 is what is compensating for, in large part, this advance. You all know that, but if you want a reminder of that, here's another really great reminder, which is underneath the surface. Mag 7, 65% in 2024, of which S&P was 23 gain, which is very good, but that's because Mag 7 is such heavily, cap weighted. All the other SPY 493, we got maybe 5%. And that includes all the quantum and, all the AI and all the whatever. So the point is we still have a lot of, I would say, cover up by the strength of the Apple, the Amazon, the Nvidia. They have not, that sector, if we call it a sector, has not reversed. So this is still the problem. Underneath the surface, we still have weakness. Mag 7 is still holding up the market in expectation that earnings will grow 10 to 15% in 2025. Color me skeptical. And then, of course, we do have a rising dollar and yields, which is absolutely interrupting the bullish flow. And so that's what I wanted to talk about with you today is what do you see with option flow on the aggregate? Because I still see that and I wrote about this also on that Monday, that beneath the surface, Brett might be breaking down, but the option flow still leans bullish. And the North American active investors, they went from 100 to 60 in like a New York minute. So they're really fickle. They're nervous. They're waiting for Trump's policies to be announced. And when you get stuff like we had today, well, Trudeau on Monday, and then this kind of nonsense. So we know Trump is the master of distraction and confusion, and he's doing a great job. Greenland, go, right? So, there's all kinds of disguise, I think, for really what he's trying to leverage and get done. But the problem is the market doesn't know how to price any of this in.
Yeah.
Not for earnings or not, and not even for dollar in yields. All I know is my continued warning that this bifurcated market that I wrote about for clients, right? Like you said, dealers are negative gamma, and we could definitely trigger that 58.50 and get some more selling going. But ultimately, we're just trying to get through the inauguration of January 20th and then find out a little bit more about these programs. In the meantime, the dollar is moving higher and with all kinds of really good macro reasons. So even Trump coming in Tuesday morning and trying to talk it down, which was hysterical. He's like, the interest rates are way too high. It doesn't work anymore. That worked in 2017. It's not going to work in 2025. So again, I think we have to keep eyes on the prize, dollar yields, a little bit of the oil, but I think that's going to settle back down. And watch the option flow. But right now, it's not falling apart.
Well, and like you say, it's hard for them to control the narrative because the rubber's finally hitting the road here a little bit. And there are things afoot since they started to cut rates, or since they were hoping to cut rates even more, we've seen the 10-year run up 100 basis points. So there's sort of kind of it's a tale of two kind of rate environments in a way. There's reality, and then they're hoping to do something that may not be possible for now. And I keep telling people, well, the Mag 7 are kind of a place to hide, and they don't really care about interest rates. And I say that sort of tongue in cheek because sort of a line from there's one of my favorite movies about a boy, and the guy says, no man is an island. Well, no sector is an island, right? At some point, the economy does matter to those stocks. We can't just say that they're never going to care about interest rates. They don't care about interest rates because it doesn't affect their business, their business per se. They don't have to borrow money and things like that. So they're kind of these balance sheet heroes that everyone can run to. But at some point, if AI kind of eases off and the economy softens, then it will affect MAG as well. So for now, the narrative is hide in MAG while rates are high and the rest of the economy is kind of going, like half of the Russell is 50% floating rate. It's not healthy, but
no,
I think
but
that gets solved.
It's also one tweet away from this type of implosion accident where Jensen is at the CES conference, and last night he utters the words quantum, and then he follows it up and nods to his CFO that it's a good 15, maybe 30 years away. And then literally the darlings that have also been a momentum sector day trader's dream, right? With lots of options, very risky. And some of them are extremely parabolic. In fact, we created this list way late. Mikey was way early on all this stuff. But in any case, we have this list.
Okay, All Seeing Guy says the recovery from Cali fires will boost the cat stocks. I think California probably will. Yeah, I don't know if that's going to help cat stocks. I mean, you're basically have to assume, because cat is actually a global company, you're going to have to assume that there's going to be more than just California. You're going to have to assume that people are going to build in general in the next coming years, more housing or construction. Yeah, in a higher interest rate environment for America, however, I think that's going to be tougher. So unless interest rates are going down, yeah, cat stocks probably will have trouble. And since they are a multinational company, higher dollar means they are getting less profits from overseas because of the currency conversion. So a lot of the stuff I talked about in this stream will affect that stock more than any boost in California. And California has high regulations. Good luck with the building permits. So unless we're going to build those mega cities that I was talking to HB about on the streams, yeah, it's going to be tough. And, you know, if you look at Deere, same thing with the farming equipment. Like Deere stock looked like it was going to break out, and then it just completely broke down from that. So, yeah, I'm not optimistic on farming, construction, or anything right now at this point. Unless you're talking about mining, yeah, maybe, you know, if there's more mining, then yeah, of course. But let's see how that goes. That also requires a lot of regulations and permits as well.
And outsized, and then today they opened up to a very big trend reversal. So this is definitely what happens when you have a parabola very extended from its mean, and then you have literally one sentence and boom, they're down 30, 40, 50% because parabolas are trapped longs, and all you need is a trigger of volatility, and that creates liquidation. And so that's what we saw today. Mag 7 isn't that. A lot of these plays have been, you know, they're unprofitable tech, but they pulled forward a lot of growth. NVIDIA has pulled forward a lot of growth, and it's stunning, and everyone's, you know, starstruck by the celebrity CEO. But the point is, this is the air pocket of risk that I look for in everything. So we need to kind of just not be complacent. The market is definitely getting tested.
Yeah, the parabola market, I mean, that sort of didn't sit well with us. It was nice to see for equity holders, but you know, that post-Trump parabola market almost, and it wasn't even just in the IONQs, it was kind of all over the place. And so that just sort of brought forward a lot of potential performance. And I think the market's having to kind of work that off a little bit here. I think in general, from my perspective, we might disagree on some things, but you know, I think in general, the data is pretty positive in the economy. I think there's a lot to be positive about, but hey, we've had a couple of years of 20+ performance, and it's, you know, we're gonna have to work things out a little bit from a flows perspective. I think that if we can get above, I'm telling members, listen, if we can get above 60-50, I think we start to get into an interesting place, right? So we're going to go from that short to neutral gamma environment back to, and it's not always intuitive, right? You think, well, buy them when they're on sale, but from a trader's perspective, it's right here, things are dangerous. But if we can get up to 60-50, then that's an area where I think dealers start to get saddled with a lot more premium, right? We get up there, everyone's hammering out their cover calls, they're giving them all sorts of option volatility, and that's going to create a much more supportive environment that's going to clamp down on volatility. And then maybe we can then start to kind of grind our way up. If we get up there. Now, if is an important word here, and gamma in itself doesn't really cause problems. It can be an accelerant, it can be a decelerant to volatility, but we need that sort of spark. So we need something to kind of get us up there. Earnings season starting soon. Maybe that's the thing that gets us going. But we sort of pointed this out a couple months ago. We said, you know, the beta to VIX of the VIX to S&P is just massive. And that's why I've been favoring you. I noticed you also picking some nice VIX trades as well, protective trades. Beta of the VIX to the S&P has been really, really high. And so you can see right here, this is showing exactly that. So when the market comes down 0.5%, 1%, 1.5%, we can see the reaction of the VIX. And here, since that August horrific week, we see that now whatever the reason is, maybe dealers are on edge since those days, but we now have this ability for the VIX to really, really react. And one of the charts that I like to show is, this was from about a month ago. And I sort of looked at this and I went, boy, look at the steep skew on the upside calls in VIX versus the month previous. So what that means, I mean, there's a few ways to interpret it, but basically people are pushing up those out of the money calls, which is what you want to own if you believe there's going to be a severe sell-off or a crash, right? You want to own upside calls, which is a little different from owning downside puts in the S&P. In the VIX, you own upside calls when you want to play for that crash, for that big sell-off. And this either means that people are super hedged, or dealers are going, you know what, I can't sell any more of this stuff. So that probably has something to do with August and early September, where risk departments are going, listen, you cannot get into an ugly situation like that again. You have to, if you're going to sell this stuff, you better sell it for a whole bunch of money. And as a result, you can see dealers are already short a lot of calls in the VIX. So I think that continues to be an interesting place to place our bets from a hedge perspective, or even just if you want to create some alpha from a sell-off as a trader. I'm sort of talking about selling, Feb, I might move to March soon, but Feb 15 puts, 16 puts to buy some upside calls. That's what I'm sitting in right now. I'm out a little bit of money on those, but I think they set up quite interestingly. If you think that the next month or so might be a little bit concerning, and there's certainly a lot of catalysts that we could be looking at that could cause some problems, that's where we are. Now, from a gamma perspective, here we are. We can see this sort of red square down here. This is where we are. So this isn't rocket science. When I say below 59.75, this is where we have pockets of weakness from a gamma perspective, where volatility could continue. We've seen it a number of days this week where S&P is up 70, 80, and then it gives back a good chunk of that. Again today, we rallied back, so that was nice to see. But if we can get up into this sort of 6,000 plus territory, that could do a lot for us. But gamma's a really big thing. From December 30th to right afterwards, we saw one of the biggest drops in gamma that we've ever seen. Only August 5th was from pre December 30th to afterwards. So a lot of gamma kind of disappeared there. And so now you have this, they say the largest 4-day change in their data set ever in terms of going from positive and flipping down to negative. So they've gone from positive 12 billion per 1% move when you're positive, you basically have 12 billion to buy, 12 billion. That's very supportive. This is an area where there is that possibility that you kind of can't trust the rallies, and maybe you can't really trust the sell-off. So we have to get used to this volatility until we get down. And I think that happens maybe around 60, 50, where maybe things calm down a little bit. Here's your return contribution.
Oh man, so you only gonna get a calm reaction from the markets if you get an S&P 500 at 60, 50. Okay, that ain't gonna happen. I mean, I don't know. Y'all seen guy cat release, like that's probably like the CES, they got a lot of AI and all that stuff too. They're putting farm equipment, construction equipment, they're putting AI, GPS, all kinds of technological advances on everything. But the problem right now is that this year it's going to be a sideways type of market, pretty much. You have dollar rising, yields, bond yields rising, and you have a Fed that doesn't want to cut rates, worried more about inflation. You have earnings, which has to make up for all those things. You have a dollar that's too strong. Yeah. So yeah, you have to have earnings to overcome everything. Earnings that have to show a lot of growth. This is where the issue comes in. So, and then Trump's going to come in, and then that's going to add more uncertainty to the markets with the tariffs and this and that. So yes, things are not going to be easy like they were in the past 2 years, when the Fed crashed the whole markets in 2022. So 2023, 2024, you're done. We got 2 years of very good growth in the S&P 500. You had basically back-to-back 20% plus years. Is that going to repeat for a third year? Good luck with that. That's what I'm saying. With the dollar high, the yields high, and now all this other stuff, this oil rising. And if China fixes their economy, oil will definitely rise. That'll make up for the weakness in the European economy. And so, yeah, we got 3 things against you. So that's a problem. This is a big problem.
Way you can't trust the rallies, you can't trust the sell-offs. And I literally have said, I don't trust this as far as I can throw it, meaning we're just in this chop slop. And yet the option flow is still hanging in there. We have you seen any other kind of indicators of worry?
I mean, apart from the sort of gamma picture that we're seeing, not really. I mean, I'm sort of looking at areas. I know you think that that the semiconductors could have a little bit of a run. Almost looked like we were going to get going the other day.
But I also said that popped up $10, the SMH, and I literally posted in my swing channel, right? Because I have that NVIDIA finance call spread for March. I said, all right, I'm taking 50% of that off because it's up 5,600%. But I'm keeping 50% because I still have March. I mean, I'm keeping the 50% of this open because I think that after we fill the gap that we just made, this absolutely exorbitant jump in semis too, right? From 252 to 262. I said, we have to go back and fill that and then we can continue higher. So the fact that we came down the next day, okay, it was a little sudden, but I knew we were going to come down and go fill that gap before we move higher. So that's another reason why, believe it or not, I'm not worried about that long in NVIDIA or SMH. I still think the Qs can hit 548. SPX can hit 6150, but not right now. Right now, they've got to let go. There's this clench of concern, at least getting through, I think, January 20th. And then I think they'll be able to move.
That's right. We need the unclenching. I've seen somebody call it that. They call it the unclenching. We need a bit of unclenching. But I like it. I have to admit, I've been impressed with your resolve with that area, and it keeps coming back. It had a nice little run there, and that really ugly red candle yesterday. But I'll tell you why I'm still maybe a little bit. I think the news was positive. I know it was a bit more retail oriented, but it's a retail kind of show. I think there's more to NVIDIA than the sort of prevailing narrative. And I mean, the AI is really, really huge, but the sort of other spokes in the game, I think, are sort of revealed themselves a little bit. They've got this $3,000 computer. They've got these deals with a number of Chinese car makers. They've made it clear that they're going to help others succeed in the robotaxi game, which maybe led to partially to some of the Tesla weakness. So I think NVIDIA is still in the game very much in a lot of different ways. Kind of reminds me of, I remember 2018, I was really focused in the blockchain area. And that's all anybody could think about was, oh, NVIDIA is all about blockchain. And they just kind of forget about everything else. So don't forget this company has a lot going on. It's not an insanely expensive stock. And so I'm looking here, I can see it's going to have to get through that 150 call wall again. I thought it was a little bit horse out of the barn, but here we are. We're going to have to kind of scale that wall again and jump over the other side. But once we get up there, there's not a lot of flow in the way at that point. So I think that's kind of interesting. And look at the SMH, aggregate dealer gamma. So we're talking about gamma again here, folks. So hopefully everybody's kind of on the same page here. Basically, we're a bit positive gamma in here between 240 and 260. We've got this wall around 265, let's say. But beyond that, this reminds me of when NVIDIA was under 120. And I said, if we can get through 120, we could sort of melt up from there. This gives us the potential for a melt up as well. We can get that SMH back to 260, 65. Then the coast is pretty clear for a bit of a melt up. So I'm not saying it's going to happen.
262, 63 on a weekly close, to be exact.
Okay.
Mm-hmm.
That could be it. There you go.
But I also have mentioned repeatedly, add time. We have got to get through this January 20th, chop fest. And then NVIDIA earnings are September 19th. So it could run up, and that was my goal, really. It would just run up into earnings and you could, buy the rumor, sell the news. But for right now, it's fine. Like I said, I'm not worried, except underneath the surface, I do see this air pocket of risk for more of this intraday chop. Fundamentally, macro, and then of course my intermarket, and then just the flows and the net selling. It's still in the house. So they're not buying this narrative that we're ready to go higher, period. But options is still sticking around, and dark pool activity for investors is still positioning in tech. So they're also not, they might not be buying aggressively, but they're not selling. So kind of like I don't trust the rallies. I don't trust the sell-offs. We're just waiting to get through this period. No question about it. But I think Rich is kind of mentioning he treats this on a weekly standpoint of looking for drama of in other words, crash scenarios. I kind of look for a reason to crash, which is why I study the yields so closely with the dollar, because once we leave that Goldilocks region, then we absolutely have a reason. And if I see selling underneath the surface, which we have, by the way, we're leaving the Goldilocks in the 10-year and soon in the dollar. So if we don't get intervention to tap that back down, and Trump talking it down is not going to work, then I look for the structure of the market. And right now it's bifurcated. They're underneath, they're selling the underlying, but they're buying the options. It's almost like it's a proxy. They're lightening up their risk. Is that a better way of putting it?
Could be, it could be a little bit of stock replacement. You kind of take some risk off, some higher delta risk, delta one risk, and you kind of replace it with some upside convexity, some optionality to the upside that can maybe kick in if we do get another melt up. But in the meantime, you're going to create a little bit of dry powder in case you come back down. So there may be a little bit of that happening. I mean, I'm sure your typical fund manager isn't going fully to cash, but if he or she goes from 98% to 92% or 90%, that's probably a big deal. So that's probably where you can maybe move the needle a little bit on the option side of things. And
Okay, that's a lot of information packed right there. Selling shares, buying options instead, raising cash, all that stuff happening underneath. So, yeah, there's a lot of things when you have a lot of big money people. They have a lot more options than you, right? And they will consider whatever it takes to reduce risk, but at the same time, in case the stock market goes back up, they'll increase their gains. So that's where the options comes in. That's where all this stuff comes in. So right now, they were talking about SMH, and she was saying like if it got above like 265, we could have a squeeze based on the gamma. And we are now at back at 246. It was at a high maybe in January 6th last week at 262. It got there. That's when I sold my SOX L ETF, and then it came back down based on just chart reading. So we're stuck. We are stuck in that wall. And he was explaining why that area is so important, because if you broke through it, it would just melt right up. But now we can't. So again, we are going to be in trouble for a while. And they're hoping that it'll be resolved January 20th. Probably not. Probably just January 29th when Jerome Powell speaks again, because whatever he says matters. And before we end this stream, got 4 minutes left before 2 hours. I'm going to replay this thing from the Wyckoff guys where they were showing the analog, okay? And this is what I'm saying. This could be like we could go sideways and then just go down, But that's just a potential. Doesn't mean it's going to happen.
Bruce, just having some kind of trading range going into the new year, having that February decline that could come a little bit earlier. It could come in January.
February decline. So we're just going to go sideways and then we're just going to drop in February. Okay.
Creating that type of local capitulation into the area where we had the decline before, the test before, the resistance become the support, shaking off weak hands by getting out of the channel like we did here. If we have something like this on the takeoff, that would indicate that we're done and we could start going up.
And when we were in the classroom, we were always saying, describe the motives of the composite operator. Think back to that MAGS chart, that ETF chart, and all that volume. We must assume that volume's so high that the MAGS, that the CO has dumped supply out into the lesser institutions in the public, and that was never in a hurry. They just raised cash. They want to buy good stocks at good prices. So they're going to wait until there's generally real pessimism on the street before they're going to step up and start to build support in these stocks.
Okay, so yeah, I mean that's one potential. I don't know if that's what's going to happen, but I gave you my opinion. I'm sure everyone has an opinion. I don't think any of it matters though. We got to wait for the earnings. We got to wait for Jerome Powell to speak again. All it hinges is that point. Otherwise, we don't know. But I do expect something to happen in February, and based on cycle analysis, it looks like more likely down. And that will align with the Bitcoin prediction where, yes, Bitcoin will start dropping rapidly into March and then have a bottom sometime late April after tax season, which I think will coincide with the NASDAQ as well. So, thanks, guys. A lot of you guys have been watching this show. And it's been really great. We've been doing this for like over 3 months now. Hopefully we can continue, hopefully I can start doing more shows where we do more lessons again, like we did in October, in preparation for April's dip. So let's see what's going to happen there. And then also do some scanning and things where we do some more picks, for every week. So yeah, that's what I'm hoping for. But for now, hold you tight. Clench your sphincter, your anus, whatever, because things are going to get rough. We're just going to chop, chop, chop. Don't know where anything's going to go. And then we are going to have a crazy year, I think. Crazy year, man. I think it'll be a lot easier in gold and silver, hopefully. Man, I'm hoping so. As long as gold and silver keeps going up. I think that's where we're just going to keep hiding out. And then natural gas in the summer. Okay. 2 hours right on schedule. I'll see you guys.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go.